Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. You know, fixed income yields have been a hot topic over the past couple of years as yield volatility has increased. You know, after a solid end to 2023, it has been a struggle for fixed income during the first part of 2024. Really, in general, but outside of high yield and shorter term issuances, which have performed relatively better than the broader fixed income space this year. Well, I'm very excited for today's show as we have on a very special guest who is part of a PSN Top Gun award winning asset management firm to talk all about fixed income markets. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I'd like to give a very warm welcome to Stan Sattler. Stan is the Director of Investment Solutions and partner at Belle Investments. Stan, thank you so much for coming on the podcast. It's an honor to have you on. You know, can you please tell us a little bit more about yourself and the PSN Top Gun award-winning Belle Investments?
Thanks for having me, Ryan. We've been a big fan of your organization and the podcast for some time prior to the conferences and all that. So appreciate that. Myself, let's see. I've been doing this for 16 years. I grew up in New Jersey, graduated UConn. Classic story. Met a girl, never left Connecticut. It's always a girl or a job for us, right? I grew up on a trading desk, sort of portfolio management type of roles. Moved over to distribution along the way. I tend to focus on the podcasts, the presentations, and our larger partners around the country. Belhaven's a boutique fixed income manager. All we do is fixed income, 19 billion in client assets, track record going back almost 25 years now, consistent, repeatable outperformance. Don't try and be all things to all people. Really try and stand out from the crowd and be an alpha generator, a safety generator, and a differentiator in our asset class, which is tax exempt and taxable fixed income.
Fantastic. So did you celebrate or have you been celebrating a lot UConn's basketball success recently? And were you sweating it out when Hurley almost went to the Lakers?
Gosh, there's a lot to unpack there, and I don't want to take up the whole podcast talking about it. But to say that some of my colleagues at Belhaven aren't too thrilled with me because I've won some additional March Madness pools, rooting for the home team is needless to say. I've been fortunate. Obviously UConn's relatively local to where we're based in Westchester, New York. So I've been fortunate to see a bunch of their games and even see some of their tournament games in New York and what have you. And it was pretty devastating when I thought Hurley was leaving. But there was that holdout of he has the flair for the dramatic, and I think he's just trying to be dramatic and get a contract. So all worked out. All is right in the world.
Bring in some more eyes to UConn and exactly what they're doing, right? He's good at building that brand and that excitement. So exactly. back to task at hand here in fixed income. So, I mentioned at the beginning, it's been a bumpy ride, a little bit of a struggle for fixed income during the first half of 2024. Where do you see risks and opportunities in 2024 and moving into 2025?
Yeah, it's been a bumpy ride because obviously the risks were all interest rate focused. So if you had an interest rate sensitive portfolio, you felt the pain for some years. And not that we didn't feel the pain, but we tend to build laddered type portfolios, staggered maturity type portfolios. So individual bond SMAs, laddered structure, tend to do fairly well and work out to the client's favor when you have that interest rate volatility. But I mean, look, we're a conservative fixed income manager, so we can't help ourselves but think about risks. That's all we do. That's what keeps us up at night. So, for us, I mean, there's certainly some economic risks that are out there. I think that the world has gotten a little complacent on the post excitement of whether that's the Magnificent Seven or AI or the stock market post COVID doing well, that some have been asleep at the wheel on the potential risks that are in the economy and haven't gone away over the past 12 months. So Areas of financials, regional banks particularly, are still concerning to us that we're very cautious around and shy away from. You still have the woes of the commercial real estate, the fixed income underwater, the deposit flight. The Fed has a lot of influence on the results around those financials, but for us, this economy is probably going to slow over the next 3 to 4 years, and we've seen a lot of complacency for that potential slowing. I get the risk-on environment of equities, but it's transcended into the credit markets, our world, and that doesn't really add up for us. So when we look at it, as institutions look to rebalance into fixed income or gravitate to the absolute yields that are in fixed income, you've just seen credit spreads continue to move lower and lower and lower and lower and lower. And to us, that reeks of complacency.
Mhm.
So we're very cautious around that. There's obviously always pockets of opportunity for all different types of fixed income managers. But because of that, when we look at the ultra high grade conservative space, one area that we've reduced exposure to is just corporate balance sheets in general, corporate bonds, particularly the financials, but really just corporate credit spreads in general. Particularly, you look at the corporate bond space, and there's not a ton of opportunity in our view. And I know many guests may feel differently because it feels like the best game in town. But for us, we've moved our exposure from those corporate bond positions into the asset class of taxable municipal bonds. So the second half of your question, I believe, was risks and opportunities, and to us, it's one of the same, right? Increasing economic risks and tightening credit spreads are a recipe for underperformance in the future, in our view. So how do we find better opportunity away from those tight credit spreads? We've done that by reducing our exposure to corporate bonds and into the taxable municipal bond market, which we'll spend some time on. But if there's anywhere we see opportunity, it's that space.
Fantastic, Stan. So much there to unpack. A lot of information. It's interesting you brought up financials and banks. We're a year removed from that regional banking crisis, over a year removed, in fact. And
Yeah.
and you're exactly right. It's seems like a lot longer than a year ago. And people have kind of forgot about it. But I've had other conversations about people saying in firms saying that it's not over with yet and there could be some more trouble ahead. Can you maybe go a little bit deeper into what might be impacting those financials?
Yeah, I mean, the crux of it is, Ryan, is that the banks were in trouble because of their fixed income holdings and their deposits fleeting. So if on their balance sheet is fixed income and those need to be marked to market at lower valuations, the bank's balance sheet is hurt at the same time where deposits are moving into treasuries, money markets, fixed income off their balance sheet. That we all knew of, and we knew of the commercial real estate concerns. The banks have been protected a bit from our government, verbal backstop, if you will, and the plans around keeping banks solvent post SVB and others. But the commercial real estate concerns, while in some areas maybe priced into the market, are not priced in across the board, and many have fallen asleep to the idea because no one's been able to mark to market these assets because there hasn't been a lot of transactions because there's been the extend and pretend. So if we are going to stay in a world, and this is the evolution of the past 6 months, if we're going to be in a world where interest rates are going to remain elevated for a longer period of time than originally thought 12 months ago, that puts pressure on commercial real estate, that puts pressure on banks' fixed income holdings, that puts pressure on their deposit base. All the issues that existed 12 plus months ago for the regional banks, where they were extend and pretended and sort of just pushed down the rabbit hole and off their balance sheet, comes back into the forefront. So for us, there's opportunity there. There's some yield, there's some spread. But for us, that's a game that if you're a fixed income investor looking for a little spice, I get it. For us, it's sleep at night, conservative fixed income. There's plenty of opportunities. Our job is to keep you out of harm's way. And that's an area where we're not necessarily assured that there's going to be a ton of pain in the banking. But if I was a gambling man, that's not a place I'd be putting my chips.
That's a fantastic recap. You also talked about spreads and credit spreads, and we're going to talk about this later on in the conversation, but it's really interesting, especially on the high yield side. The spreads, they do not signal trouble ahead. It's smooth sailings. And it's like you said, it's like maybe people are just too complacent. Markets are too complacent, just like you said, and you see it in that spreads being narrow.
You have, that's what everyone's looking at right now. They're looking at, okay, so investment grade credit spreads are tight. Perhaps that's just because the flood of money coming in to capture those absolute yields, the yields that are more attractive than they have been in years. But then high yield doesn't really make sense, right? So people are latching on to this idea of high yield on the backdrop of, I'm not seeing a lot of bankruptcies. The economy is doing well. I think we're going to see lower interest rates in the future. I want to capture as much yield, as much spread as I can today. And I get that. It's enticing than numbers that are in the high yield space. I'd be more of a fan of high yield if you are trying to rebalance away from equities and away from perhaps more risk. And high yield is your version of decreasing your risk. But to make a big stand on high yield right now makes us pretty nervous. And the main reason it makes us nervous is that our view, our big macro view would be that if there's the next risk in fixed income, it's not necessarily an interest rate risk or a structural risk or a liquidity risk. It is a credit risk. So it is tough to decipher right now how tight those credit spreads are compared to where we think the credit risks are going. So it's the classic skate where the puck is going, not where it's been type of mentality. And we don't see a lot of attractiveness in the high yield space because of that. If you are going to invest in high yield, do it in a fund structure so you can get hundreds and hundreds of holdings to help diversify your risk. Do it with a relatively low average maturity or duration, so you're not pushing that risk out over 30 years and having that volatility. But just be cognizant that also a lot of the high yield space is levered. So now you have risk levered on risk. And it doesn't seem like a great situation given where we think the economy may be heading.
Fantastic. Great information and insights there regarding high yield. Since that, and you mentioned the Fed earlier, we can't have this conversation without talking about the Fed. So since the pandemic, there has been that divergence between what the Fed is forecasting or signaling with their dot
Yeah.
plots and all that good stuff, and what markets expect and want. Where do you stand when it comes to the Fed? And do you believe in the Fed's forecast of one rate cut this year, but also maybe keeping that door open for a second? Or do you side more with markets which are forecasting two or more cuts this year?
How much time do we have, Ryan? 2 hours for this one? Gosh. All right. Let me try and help summarize this for those, because obviously this is the hot button topic, right, Ryan?
Yeah.
But the markets haven't trusted the Fed for some time, and that is primarily due to the original Fed pivot of we are not raising interest rates to we are raising interest rates and we are raising them fast. Felt like it came out of nowhere because inflation felt like it came out of nowhere to them. So the markets lost a bit of trust and coupling to the Fed. So to your point, the market has priced in a very different event than the Fed governor's dot plot. And that's a pretty rare occurrence, but it's happening because of the recent history of the Fed on missing the mark on inflation, not capturing higher interest rates. We could spend a long time on how that happened and why it happened. I mean, we were printing money and operating in a zero interest rate policy for a long time, and we couldn't create 2% inflation. And then all of a sudden we woke up 6 months later and there was 5+ inflation. So there's a lot to unpack there on how that all came to be, but the investing world lost a lot of confidence in the Fed. So to your point, there was a point, gosh, perhaps just 5-6 months ago, where the Fed dot plots are telling you there's going to be 2 interest rate cuts and the market's pricing in as much as 7 interest rate cuts. So how did we get that decoupled, right? How do we get that off base? Part of it is the market wrestling with the idea that the Fed will ultimately be cutting interest rates gradually if the economy lands softly
Mm.
and we get inflation under control. But what the market was trying to grapple with is what happens if we end up in a dire economic situation, this recession or economic slowdown that everyone mentioned was coming for quite a long time. You have to price in the tail risk, because in that event where the Fed cuts, the Fed doesn't cut slowly.
Yeah.
They cut slowly at first and then they cut all at once. It's the classic escalator up, elevator down situation. We saw that in 01, we saw that in 08. When the proverbial ish hits the fan, the Fed cuts substantially. And when they go because they need to protect the economy. So that's what everyone's been grappling with. Since then, the recessionary risks have been reduced, at least on paper, at least according to the CNBCs of the world, have been reduced pretty meaningfully. So the market has inched their way closer to the Fed dot plots and what the Fed's setting expectations. Today, we're in a world where, unless something breaks, which is still on the table, we see it pretty difficult for the Fed to cut interest rates in advance of the election. But once we're past the other side of this election, it'll be based on the economy, obviously, but we would expect those rates to move lower, regardless of who's in office, regardless of who wins. A lot of folks are running around saying that one candidate is good for bonds, one candidate is less attractive for bonds, and the less attractive is obviously they're referring to Trump, the more attractive they're referring to Biden, just based on their current policies. And I get where they're coming from that perspective. And I sat down with our investment team, our portfolio managers, Matt Dalton, our CIO, and went over this. And the first thing that popped in their mind was, don't forget how the Trump administration put a lot of pressure on our central bank to push interest rates down. And don't be surprised the power that may have in the future if you see this economy slowing. So I think regardless of who ends up in office, I think there will be pressure to keep this economy humming and get interest rates lower, particularly if you start to see some more pain in commercial real estate or banks. So we think unless something evolves in geopolitics or what have you, all roads are going to lead to lower interest rates. It's just about timing that. And ultimately, it's going to be driven by the Fed on the front end.
That's really interesting. I'm glad you tied in the election there. With all the uncertainty, I tend to try and not get into politics here, but it's hard not to in this industry, right? And just the uncertainty. But at the end of the day, more so on the equities, sometimes I feel as if the election is a little bit over talked about when it comes to investments. And studies show that markets, especially equities, tend to do well immediately following elections, whether it's a Democrat or a Republican. Talking about yields, let's talk about the yield curve. We've
Yeah.
talked about, what's the saying? The past 6 recessions have been, or whatever, all the recessions are predetermined or predicted by the yield curve, right?
Right.
Well, the yield curve has been inverted now for some time. And a lot has been made about it. It's steepened a little bit recently, but it still remains
Right.
inverted. What's in store for yields for the remainder of 2024 and 2025? And do you believe the curve will normalize?
Gosh. Okay. Yeah, your first point spot on. It's the longest inversion in history, Ryan. We're 20 months of an inverted yield curve. And everybody says this time is different or there's a reason or what have you, and maybe it will be. There's no such thing as one good predictor of a recession, right? If it was that easy, this business would be off and running on being accurate on investment decisions. It's just not that easy. You've had a lot of volatility. You've had a lot of pretty polarizing opinions on the direction of the economy, the direction of interest rates, the direction of the Fed. What should we do? What would I do if I was in office? Type of mentality, right? Very polarizing opinions in this country, and it comes down to the yield curve as well. So you talked about normalization. Yes, the yield curve will normalize one way or another. We believe that ultimately the Fed, the short end of the yield curve, which the Fed obviously controls, is going to be the first big mover. And that's going to be in the direction of lower, perhaps gradually or perhaps meaningfully, depending on what happens with economic numbers. And then as that happens, there is potential for money to move out of short-term bonds into intermediate and long-term bonds, either in a risk-off scenario or a lock-in what's left in the yield curve scenario. But there also is certainly risks out there that geopolitics, the deficit, debt gets out of control, and you see pressure on the long bond. And that's what you've seen recently. That's what you've seen just this week. I know this podcast recording comes out in a week, so we're talking technically a week prior, but you're talking post-debate where it looks like the right has been strengthened. You're talking post-France where it looks like the right has been strengthened. Those are policies that should, in theory, lead to a greater deficit. So the long bond has felt pressure on it, because there is this narrative out there when you take a view back that when a country takes on debt and deficit, that should mean the market needs to adjust with higher interest rates given the risk of those. But and that's a common narrative out there, right? It's a very opinionated political view, and I know you don't want to get into politics, but you can't avoid it when you're talking fixed income and treasury right now, right? So I go down that topic because historically across the globe, now granted this was in a bond bull market, but historically across the globe, when deficits expand and debt balloons in countries and sovereign nations, unless it gets to a level that you can't come back from where you have hyperinflation, most of the time in the developed world, it actually results in much lower interest rates, which is very shocking to people. And there's a variety of countries you can talk about with this, but Japan's the classic example, right? Their debt ballooned, their deficit expanded, and their interest rates just kept moving lower and lower and lower and lower. The polar opposite of what most people would expect to happen, right? Now, why did that happen? Because at some point, more debt results in lower growth. So if you expand the balance sheet, you can't create economic expansion the same way, which means investors either want to go risk off into conservative fixed income, which puts interest rates down, or you have a central bank that's then trying to stimulate growth because they're having limited growth policies. Or you just have a government trying to control their costs because their debt load, their interest rate on their debt load is so significant. So despite popular opinion, unless you get over a substantial crescendo, typically a higher debt and deficit can actually result in the opposite effect where interest rates move lower and more of a risk-off environment.
Interesting. Stan, you're dropping a ton of knowledge here. This is fantastic.
It's
So
a
you're talking
Monday,
about
fixed
yields.
income. I'm just glad everyone's awake, Ryan.
Yeah, that's the key, right? We've talked a lot about yields and interest rates and maybe their direction as the yield curve kind of normalize, maybe yields coming down a little bit. For years, short duration was the play, right? When interest
Yeah.
rates were at historic lows, zero, there's nowhere to go but up. Is it time to go long duration yet, or is that are we too early yet?
I think the most difficult part of that conversation that we've had with our institutional clients over the past 6 months is take out the black and white, the opposing views of that conversation. The question is happening because we all know at some point we should probably move out of cash onto the yield curve. So do so gradually, because regardless if you're convinced you have the direction of rates right, you will never get the timing right. Yeah. This is all we do for a living, and we are not confident on the timing of the move in interest rates. So dollar cost average your way into there, or use a backup like we've seen the backup in interest rates over the past week or so. Use these backups as an opportunity to put cash to work out along the yield curve. But keep in mind that the yield curve is inverted for a reason, and we don't have to go down. We have a sophisticated viewer base here that understands why that is, but the short end is a teaser rate. And what most investors need to protect against is not interest rate risk of the future, particularly Bellhaven clients. Again, we talked about the idea of we build ladder type portfolios. They're total return oriented, but the maturity range is laddered or ladder-esque or lumpy laddered, or however you want to kind of visualize that. So you're protected against the threat of higher interest rates. If you're tucked in cash, you can't protect against what if we get back in a world where there's a zero interest rate policy or just meaningfully lower interest rates. I know that seems far-fetched today, but when the 10-year treasury was under 1%, a 5-year treasury also felt far-fetched. So don't rule it out. So depending on what you're investing for, if you're an insurance company for the long haul, you're a retiree that needs to support income for the rest of your retirement cycle, don't be too cute, if you will, and be all in on the short end. So don't make it an all or nothing decision. For me, if I have $100 on the short end, I'm talking about moving $5 to $10 per quarter out on the yield curve, and I'll never feel like I captured it right, but I'll also probably never be kicking myself that at least I got some out there.
You bring up a very good point. And, interest rates after they've still, despite a lot of people calling the peak, get into interest rates, last year when they were 5%, they're still very attractive when you consider what savers have trying when they're trying to find yields for the past 5-6 years, and they've had to go out and riskier parts of the market to get yields. Now they finally get it, take advantage of it. But I love your point about dollar cost averaging. I'm more of an equities person, but we always talk about dollar cost averaging, and equities markets move too fast, don't time it.
Yeah.
But the same can be said about fixed income. I'm glad you brought that up. So let's talk about sectors. You mentioned taxable munis. What are some maybe other sectors that the Bellhaven team believe that are most attractive moving forward?
Yeah, we talked about taxable munis. It's the second fastest growing part of the fixed income market, Ryan. But nobody's woken up to the idea. Every podcast I listen to or presentation or what have you, everybody's talking about private credit because of the growth of that market and the opportunity there. But everybody's still asleep at the wheel on the taxable muni market. They don't realize how much that market's grown, and most are just not aware of the opportunity to allocate. You have better relative yields, you have better safety, you have added diversification, particularly times in stress. So that's really the big one for us. When we look in the taxable muni market, because absolute yields are so attractive, our view is now's not the time to go take credit risk. So never mind taxable munis, take the higher grade taxable munis. And that's the thesis behind taxable munis. So buy things like higher ed, state and local GOs. This is a University of Texas, University of Michigan, State of Connecticut, go Huskies, name brand taxable municipal bonds, a municipal bond that pays taxable interest. Even in the healthcare space, differing opinions. There is plenty of pain in the healthcare space, but plenty of opportunity. If you stick to the healthcare names that are at scale, like a New York Presbyterian or a Cedars-Sinai, et cetera, the high grade, I would take those credits over the limited options in the corporate bond space. There is opportunity in the corporate bond space. We're starting to like some of the utility, some of the more defensive names in corporate credit, but the majority of the corporate bond space is A-rated or below, right? There's only 2 or 3, depending on how you define it, AAA corporations in this whole country. It's Microsoft, it's Johnson & Johnson, and then you have Apple at a split rating. That's it. So the greatest country in the world, the most conservative nation in the world, there's only 3 options that are AAA rock solid credits. And then there's only 13 or so AA credits. So if you want to allocate meaningful sums of money and you want to build a portfolio that's AA average or AA or above, you have a hard time doing that in the corporate space. So a lot of our institutional investors that are looking to go up in credit quality and really sleep at night defensive credits are looking at other areas to do that, whether that's agency bonds, government bonds, taxable municipal bonds. And taxable municipal bonds are the best of breed. So we'll still find sectors and unique opportunities in corporates and other asset classes, sort of core classic Barclays Ag, if you will, type of credits. But the best bang for your buck right now, if you just look at bond selection, sector selection, you're going to find that in taxable municipal bonds.
Fantastic. Love it. Love it. And I think, a lot of people just talk about your typical tax-free municipals, or so it's interesting to talk about taxable munis. So you mentioned that. Is there a Bellhaven strategy that might best capture the investment views that your team offers moving forward?
Yeah, what we like to do is work with our partners, as you and I have talked a lot about this, is we have composite strategies that a lot of folks will gravitate towards, but then a lot of our partners are looking to accomplish something very specific. They're looking to match future liabilities, whether that's corporate cash or whether that's future liabilities, such as an insurance company or a client that needs to buy a house one day or whatever the situation is. So a lot of what we do is tailored particularly around the maturity schedule. But the taxable plus strategy is really where you get the best that Bellhaven has to offer. That's where you're going to get the bond selection, the sector selection, the yield curve positioning, our unique advantages when it comes to trading. And that's the one, obviously, that's won all the awards, the Top Gun awards, PSN Informer awards, and all that. That tends to gravitate to get the attention. It's a 1 to 15 year intermediate total return oriented strategy. Pick a time frame, 3 year, 5 year, 10 year, since inception, consistent outperformance over its peer group and the benchmark. And a lot of that comes from just picking the safest and most attractive relative value areas. So whether that is corporate bonds or agency bonds or taxable munis, and ebb and flow between where that opportunity set is.
Interesting. Real quickly, last question, another minute here. Let's talk about SMAs real fast. That's where Bellhaven, your investment vehicles, you talk about composites. What are you seeing in SMAs? You guys seeing a lot of popularity in that investment vehicle versus um, other types of investment vehicles?
We are. We're seeing a lot of popularity in the SMA space. Mutual funds certainly have their advantage. We're very familiar with the mutual fund space. We sub-advise mutual funds for insurance companies and our partners, Transamerica, et cetera. But the mutual funds are fantastic in diversifying away credit risks and having consistent alpha ability because of all the names that are in the mutual funds. And they're scalable, they're convenient for the investor. You can put them into a model, they're off and running. They're a good structure. But for those that are looking to allocate significant sums of money, you can't beat the SMA. And that really came to light just in the past 2 years from what happened with interest rates. Because if you're in a mutual fund and interest rates went higher, you're waiting for performance of the mutual fund to then overcome the losses that happened on your NAV, your bond value. You need performance to overcome that. If you're in an SMA, you have the maturity schedule. So if you're building a staggered laddered bond portfolio and you have that maturity schedule, despite interest rates moving up so aggressively, you know you can point to that maturity and say, well, in 3 years, I'm going to get my money back. In 6 years, I'm going to get my money back. And then I get to reinvest it at what's hopefully a higher interest rate environment. So I know it's very basic for this, this user base who's listening or what have you, but it's the reason that you've seen such success in the SMA space, because the past 2 years was a rude awakening to, oh, this is how a bond works, the simplicity of it. And you have to get back to that simplicity. And then you get the customization and the potential tax benefits and some of the nuances that are crucial for particular types of investors. So to your point, we've seen the business grow more so on the SMA side than we've seen in fund type structures just across the industry.
Fantastic. Thank you so much, Stan, for coming on the show. It really has been a pleasure and an honor to have you on and sharing such fantastic insight with us and our audience. I know I learned a lot. Where can the audience get more information about Bellhaven Investments?
Oh, thank you for that, Ryan, and the kind words. Obviously, you can just go to our website, bellhaven.com. You can check us out on LinkedIn. We tend to share a few cool charts and things like that. Again, my name is Stan, so you can always reach out to me directly. But the best way to really get in touch with us is a distribution email address, service@bellhaven.com. So SERVICE at BELLEHAVEN.com. Or you can always just give us a call. We'd love to chat with you. We're all in the office 5 days a week, working hard, working East Coast and West Coast hours, 914-816-4633. If you reach out to us, we can send you more information on the strategies, on the firm, answer any questions you may have. But what a lot of people tend to do after they reach out to us, they'll come to us, say, okay, that was interesting. I think I want to learn more. And what we want to do is have a dialogue with you. And what are you working on currently? What does your portfolio look like? What is your investor base, et cetera? And then what many do is they tend to send us outside holdings. So whether that is holdings of municipal bonds or corporate bonds or agency bonds or treasury bonds or what have you, send us those. We'll review them free of charge. It'll give you a good insight into what we're thinking. It's a nice way to sort of feel us out, if you will, kind of flirt with us. Okay, I think this is interesting, but I want to get a better sense before I start dating you, kind of thing. But it's also a nice way just to get a second opinion of, hey, this is how I've been managing a bond portfolio on my own. I'd love to hear from, I like your point of view. I think it's interesting. I'd love to hear your 2 cents on this. It's a nice way to sort of have a two-way street, open dialogue. So if you just reach out to us at service@bellehaven.com, we can set up a quick call and discuss next steps or things like that. And then hopefully Ryan will have us back on a regular basis, and you all get to hear more from us. So thank you.
Fantastic, Stan. Yes, that's a guarantee. Not many guarantees in this industry, but I guarantee you will be, and your team will be invited back on the show. Thank you again, Stan. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you so much, and have a great rest of your week.